2023 is ending. Pandemic is finally out of our lives. The world is continuing to learn to live with the excess dollars. India has become the most populous country, sixth of size of China though. EVs powered by coal are taking over the world. Middle East is trying to reinvent itself. Two major elections coming up next year, one in US, one in China, India. Both countries' governments have a tough job ahead. The year-on-year numbers next year are gonna be difficult to look and digest because they'll be small compared to the high basis of this year. China continues to kick every dog on the street. They have an internal problem with overproduction, overcapacity. Japan still is undecided after 3 decades whether they have a problem or not. Interest rates are figuring out whether they go up, which will be difficult for the elections. They go down, which means inflation might come back. So 2024 is gonna be interesting year. In this video, let's see if we can understand the fundamentals, which will help us be ready for that. In this video, we'll talk about the data and events that will decide probably what will happen in 2024. In specific, we'll talk about the impact of interest rates on equities, bonds, and fixed deposits. Don't worry about the analytics part of it at all. I have done the number crunching. I've made it very easy for you to digest and understand this video. Four topics for today. The first one, we will debunk certain myths and lies we've been told to believe. Then we'll talk about the current market conditions and their interpretation for you. Then we'll talk about certain data points and actionables coming out of them for you. We'll end with two real life case studies. The first one is about a real life situation I faced. No regrets, but I could have done better. Over the last 25 years, equity in India has been outperformed all the time by bonds consistently. Two gentlemen with a combined investment experience of 150 plus years and a portfolio over $350 billion. As of August of this year, they had 30% of the money, which is about $100 billion, in US Treasury to park the money till they see the right opportunity in the equity market. When we put money in a bank, say in a saving bank account or maybe a fixed deposit, a recurring deposit, we get slightly more. So if you invested a lakh rupees, you'll get a lakh 5,000 maybe at the end of the year. So a lot of us believe that banks help us make money. That's not true. Banks' business is to make money off us. They don't make money for us. So they take money from us because they need to lend it out, and that is where they make money. So we are the cheapest source of funds for a bank, and banks use that fund to give loans to people who are trying to buy an asset or a liability. It could be a home, it could be a vehicle, it could be investment into a business. Banks charge money for that, and a part of that is returned back to people like us as the interest. सही है कि नहीं मुझे नहीं पता, बट एडवर्टाइजमेंट का पैसा आप ही दे रहे हैं टू कन्विंस यू टू invest into certain ways and not consider the other options available in the market, to invest systematically every month, even though the market's at a very high point when investors like Warren Buffett, Charlie Munger would not invest. A lot of us would have entered the stock market somewhere around the pandemic time. That is where probably 50% of the new age investors entered the market. And a lot of us believe, it reflects in our portfolio also, that stock markets have been doing great, we have done well, we have made money. And we are, with that hope, investing further money via SIPs in direct equity, maybe a small case, mutual funds. So various instruments exist to invest in the market, and we've been doing that diligently every month. As soon as the salary enters our account, we do the investment. Let me bring in a very contrasting view which you might not have observed. So if you see the graph on the right side, Reliance equity over the last 1 year has gone nowhere. TCI is among the most successful Indian IT companies, slight increase, but in general gone nowhere. HDFC Bank, the largest private bank in the country, has actually gone down despite the merger, which was much hyped, with its parent HDFC, which was the NBFC arm. Continuing further, ICICI Bank, one of the second largest private banks in the country, and again gone nowhere in the last 1 year. Infosys, the darling of stock market for over 2 or 3 decades, has actually gone down. Consumption, the largest stock perhaps in the country, HUL, gone nowhere in the last year. So the top six equity stocks in the country have gone nowhere. So when we are putting money every month in the market, where is it going? Unemployment rate around the pandemic time peaked at slightly more than 14-15% in the US when most economy was under lockdown globally, and the unemployment rate really spiraled everywhere. And around the same time, the inflation nearly touched zero. There was hardly any demand. There was no way of providing the goods to doorsteps of people in general, and the consumption really tanked globally. So both graphs reflect the sentiment here. At the same time, if you see, the government had to play the rescue act, and interest rates dropped drastically, and they nearly touched 0% in the US market, which means you could literally borrow money for free and spend it or invest it into your business. The government was bailing you out. At the same time, for similar reasons as the interest rates shrinking down, the bond yields went down to sub 1%. When commercial banks need money to lend to people like us, they either use the saving bank balances, fixed deposit balances, or they go to RBI and say, hey, RBI, give us some money to lend. So RBI charges an interest rate which is called repo rate from the banks. Now, when India was hit hard by inflation, just like the other countries in the US, Europe, and so on, so RBI decided to increase the repo rate. The idea is that repo rate increase will lead to lending at a higher rate to people like us when we want to buy a home or buy a vehicle or maybe just use a credit card. So all those interest rates go up, and that leads to softening of demand, typically a tool used by most controllers to control inflation. So at 4%, the repo rate were at the bottom, probably the lowest in 2 decades, and then they started to rise. At 6.5%, RBI has taken a pause. There are state elections starting end of this month, and next year there is central elections. So at this point, governments can't afford basically economies to slow down. Neither they can afford basically high inflation. So it's a tricky situation. As of now, if you look at the graph, RBI has taken a pause in the last meeting. We don't know whether this pause will last or not. Generally, after these pauses, interest rates remain steady for some time and then they fall a bit. So my general expectation is that we for now have seen the peak of repo rates, and hence interest rates have also peaked. This does not mean they will not rise again. If inflation increases significantly, maybe RBI will have to step in again. However, so fixed deposits come with various options of breaking the FD before they mature. So the first option obviously is when you break the FD, you pay a penalty, typically 1%. There are FDs which don't charge you any penalty if you break them. Some banks which are really desperate for raising funds, they offer that opportunity to investors that come and open FD with us, will not charge you if you want to break it. There are FDs which don't charge penalty for senior citizens or super senior citizens. There are newer generation FDs, something like adjustable FDs, which realign the interest rate or coupon paid to you with the repo rate. So about 0.5% or 1% more than the repo rate, which is the rate at which RBI lends money to the commercial banks. So the penalty in those cases are pretty heavy. And then there are certain FDs where the penalty rate is decided based upon how much of the total tenure has elapsed. So I've shown two tables here. The first table shows you the penalty you will incur at 1% depending upon what was the tenure of your FD on the y-axis, and on the next I've showed how much time has elapsed in months again. So that shows you the penalty per 1 lakh rupees at 1% interest rate penalty. The second table is if you are getting say 2% extra today, and the same arithmetic is applied, whatever was the original tenure, you reduce the time elapsed, the remaining time you do the FD for 2% extra. So the second table shows you the profit or loss you will make in that calculation. Very simple arithmetic. If you need the Excel, leave a comment in the section below. I'll share the Excel for your benefit, and you can do the math on your own. The table shows the bond data for certain PSUs. This is about an year or 2 year old data. If you see, the face value of all the bonds is 1,000 rupees. However, because of the demand situation, which could be because of higher interest rates on these bonds compared to market rates, or maybe limited supply, maybe certain investors want this kind of fixed income. So the premium gets attached with the bond, which means you have to pay slightly higher than what the bond was worth to acquire it for the residual period of its maturity. So if the interest rate was 7%, you will continue to get 7%. But since you bought it for 1100, not 1,000 rupees, your actual return will be lower. And at the end of the bond's maturity, you will get 1,000 rupees, not 1100 rupees. So what happens is, in the market, if interest rates go up, the older bonds which are at a lower interest, their demand drops, because again you will get lesser on them. The newer bonds which are coming up at the newer interest rate will be high in demand. So at that time, the premium becomes a discount. So a 1,000 rupee bond might be selling at 900 rupees also. Similarly, if the interest rates drop, then the older bonds might be giving you higher yield. So the premium will go up, and you will have to buy them, say, for 1100 rupees, not 1,000 rupees. One typical practice in bond market is that if someone expects the premiums to go up, so what they do is they would buy the bonds now and start using the interest, and when the premium goes up maybe by a couple of percent, 1%, 2%, they would send the bond, which is extra income beyond the interest on the bonds for the period that you held it. Sovereign gold bonds, so the bond prices are typically linked to gold price. So if the international prices of gold are going up or down, SGB prices will travel the same direction. However, SGBs typically sell at a slight discount in the retail market. So if you go to, say, Zerodha to buy the bond, uh, if it was issued at 6,000 bucks maybe a few months back, and the market prices are not correct, then also you will get it for 57, 5,800 bucks. Because if someone is selling in distress, they have to sell it at discount. No one is going to buy at a premium or at par. So SGBs sell at typical discount in the open market. However, when the maturity part comes, you will get the bond probably at the same price of the international gold in the market. So this case study is about Power Finance Corporation, but for the fixed income or dividend yield part of it. So I bought this stock about a year back for 100 bucks. Idea was it was giving 12% interest, dividend yield, and the P was less than 2, which means the stock would get its price back by its earnings in less than 2 years. Seemed like a good deal. But then I got good 10-12% return in less than 1 month. I said, okay, great deal. Let me book the profit, buy it again when it's lower. It never came down. It kept going up and up and up and up, and it's now at 320. The dividend yield is about 4 bucks, and the P is a lot higher. Still reasonable. Now, would I buy it now? Probably no. The fixed income part of it, I miss the bus. I don't think it will go down to 100 bucks, giving me a 12 or 15% dividend again. So this is a lost opportunity. I got greedy. I thought that I'll make money in trading and buy it again. Never happens like this. So don't let go of these opportunities, once in a lifetime kind of rates. This could be something which will not happen again in 1 decade. This case study is about Reliance. So the first graph is what any investor would be shown by the fund advisors, mutual fund, equity. They will just show you, sir or ma'am, this is the standard graph. 10 years Reliance has made enormous amount of money for its investors. The graph is not wrong, but the perspective changes depending upon your zoom level. If you zoom into the 2008 Lehman Brothers crisis, you will see that Reliance probably increased 5x, 6x in just 2 years before the crisis. But over the next couple of years, painfully, it came down by 66% of its peak value, which it got before the crisis. So today, if something like that happens, based upon your appetite, based upon your portfolio, based upon the levels at which you have invested, are you ready to see your portfolio in this manner? Around the pandemic, Reliance stock dipped by about 40% and nearly the entire market tanked. and then it went up and up and up, and then it peaked, and now it has kind of range bound. So I'll tell you one very interesting element of these ups and downs. As an investor, if you are investing money regularly in a stock via mutual funds, SIPs, uh, ETFs, or anything, so one very interesting thing happens is when the market is going up, you get lesser units for the same value, but you feel happy. When the stock is tanking, when the market is tanking, and you get lot more units in the same value of money, you don't feel that good. You feel sad. Conclusion. So equity markets are undecided right now. They are waiting on the global macros. They are also waiting on interest rates. And what I feel is that the consumption is gonna peak right now. The year-on-year numbers next year will not look that great compared to the high basis of this year. So equity markets are gonna be tricky next year. I'm not saying they will go down significantly. I don't know whether they'll go up significantly. Gold will depend upon the uncertainty in the world. Gold is a hedge against uncertainty. If the wars increase, if the inflation comes back, then gold may go up significantly. Bonds and FDs will follow interest rates. The RBI governor and the Fed chair have a tough job with elections coming up in taming inflation as well as keeping the economy running. So it's gonna be very difficult for the interest rates to increase further. That's my understanding. From your perspective, there are few more factors you need to consider. The first one is age. If age is on your side, if you have years to recover a fall from a fall, then you can take risks. At my age, I am trying to move away from risk a bit because I at around 50 want to have a 50-50 portfolio of fixed income and equity. That too not very high risk equity. Your risk appetite will obviously come into picture. That depends upon age among other factors. The third one is your ability to add more money. If the markets fall a bit or a lot, will you be able to average down? If you won't be able to, then maybe you need to take a call now. The final factor is your tolerance. There will be blood on the street if the markets crash. It always has been like this. It happened during the mortgage crisis, the Lehman Brothers crisis. It happened during the pandemic. Very briefly, it happened at the Ukraine war time as well. So if you can't see your portfolio down 50-60%, and if you are into small cap, mid cap, then 70-80%, then take a call now. I'm not suggesting you sell your equity, but take a conscious decision, especially if you have not seen a large crash in life. Crashes can be 60-70-80% on certain stocks. So take a call wisely. Happy investing.